Last month I started building position 1. $8.25 received. $8.25 deposited back into the position automatically. The flywheel is not running yet. It is not supposed to be. Position 1 is still being loaded, but position 2 is already decided. The research is done. The sequencing logic is locked. This video is about QQQI, the NEOS NASDAQ 100 High Income ETF, why it goes second, what it does that position 1 cannot do, and the tax mechanic built into its structure that most investors completely miss. By the end of this video, you will understand why the sequence matters as much as the funds. In the gym, every serious program starts the same way. You do not walk in on day 1 and load the bar with your maximum. You build the movement pattern first. You establish the foundation. You earn the right to add weight. The sequential drip. Build works the same way. 5 funds, 5 positions, each one built to self-sustaining before the next position gets $1 of new capital. That is the architecture. The sequencing is not random. It is determined by one variable, the drip threshold, the dollar amount where monthly distributions cover the cost of one full additional share automatically. The faster you reach that threshold, the faster the flywheel activates, and the faster you move to the next position. GRNI goes first because its drip threshold is the lowest of the 5, approximately $2,500 to activate. At $600 a month of contributions, that is roughly 4 months. QQQI goes second, not because it has a higher yield, it does, but because its threshold is nearly $2,700 higher. You need the first position running before you can efficiently build the second. This is not a portfolio. This is a construction sequence. There is a difference. Most people describe QQQI as a covered call ETF on the NASDAQ 100. That description is technically accurate and strategically incomplete. Here's what is actually happening inside the fund. NEOS holds the full NASDAQ 100, all 107 positions, cap weighted. NVIDIA at roughly 9%, Apple at 7, Microsoft at 6, Amazon at 5. The same companies that have driven a generation of market returns. On top of that equity portfolio, NEOS writes call options, but not individual stock options, NDX index options. Options on the NASDAQ 100 index itself. This distinction is not a footnote. It is the entire tax story. NDX index options are classified by the IRS as Section 1256 contracts. Under this classification, every gain or loss on those options, regardless of how long the position was held, is treated as 60% long-term capital gains and 40% short-term capital gains, every single time, by law. JEPQ uses equity-linked notes. Those distributions are taxed as ordinary income. QQQI uses Section 1256 index options. For an investor in a 32% bracket, that structural difference is worth hundreds of basis points annually in after-tax return. Same underlying index, different tax architecture, completely different after-tax outcome. QQQI has 3 simultaneous tax efficiency mechanisms. No other NASDAQ 100 income ETF has all 3 at once. Layer 1 is Section 1256, the 60-40 split we just covered. This is structural. It is written into the tax code and applies to every NDX options transaction inside the fund every time. Layer 2 is return of capital classification. From the NEOS Annual Shareholder Report covering June 2024 through May 2025, 97.2% of QQQI's distributions were treated as return of capital. In 2024, the figure was 95.8%. Return of capital is not taxed in the year it is received. It reduces your cost basis instead. For a DRIP investor, this means every reinvested distribution buys more shares with pre-tax dollars. The compounding runs without a tax event, reducing the fuel first. Layer 3 is active tax loss harvesting. NEOS's management team actively seeks opportunities to take losses on both the equity and options positions to offset realized gains elsewhere in the fund. This is not passive. It is ongoing active tax management built into the strategy. Think of it this way. Most income ETFs give you the income and send you the tax bill. QQQI gives you the income and then hands you the tools to minimize what you owe. Those are two fundamentally different products. Now for the honest question, the one that matters. Over the past year, QQQ returned 43% on total return. QQQI returned 34%. That is approximately 9 percentage points of upside left on the table. In exchange for those 9 points, QQQI paid out 13 to 14% in monthly distributions every month, regardless of what the market was doing. Here's the fitness analogy that makes this click. A powerlifter and a marathon runner train completely differently. The powerlifter optimizes for peak output. The marathon runner optimizes for sustained output over time. Neither is wrong. They are built for different purposes. QQQ is the powerlifter. Maximum output, maximum upside, maximum volatility. QQQI is the marathon runner. Consistent monthly income, lower drawdown, optimized for the long distance. The question is not which one is better. The question is what job you need the money to do. If you are building an income floor, a system that generates cash regardless of market conditions, QQQI is doing exactly what it was built to do. The 11% you gave up in upside was the premium you paid for 13% in guaranteed monthly income. And versus its closest competitor, JEPQ from JP Morgan, QQQI wins on yield by 330 basis points, wins on total return over the past year by nearly 3 percentage points, and wins on after-tax efficiency in a taxable account by a significant margin due to the Section 1256 structure. JEPQ charges half the expense ratio, has $34 billion in assets versus QQQI's $11 billion, and has a longer track record. Both are legitimate. In a taxable account, QQQI's after-tax advantage is decisive. I want to be direct about where this portfolio is right now. Position 1, the first fund in the sequence, has received 2 distributions, $17.44 total. $2.81 reinvested automatically via DRIP. That number is not impressive. It is not supposed to be yet. This is month 2 of a multi-year build. In the gym, the first training session does not look like the competition. It looks like someone learning how to move. The adaptation happens in the weeks and months that follow, in the compound interest of consistent reps over time. The income floor works exactly the same way. The first 2 distributions are the first 2 reps. The threshold activates when the weight becomes self-sustaining, and then position 2 gets its first dollar. When GRNI reaches its DRIP threshold and the flywheel activates, new monthly contributions shift entirely to QQQI. At $600 a month, that is approximately 11 months to QQQI's threshold. Position 2 then self-sustains. Contributions shift to position 3. That is the architecture. 5 positions, each one built to self-sustaining. The income compounds without selling a single share. Current QQQI stats for the record. $10.92 billion in assets. Institutional grade liquidity. Expense ratio of 0.68%. Launched January 30, 2024. Trailing 12-month yield of 13.41%. This is not a young fund taking on institutional risk. This is a proven strategy with real scale behind it. If this sequence makes sense, hit subscribe. Position 3 is GPIQ from Goldman Sachs, the NASDAQ 100 version with a flexible options overlay and a different risk profile. That breakdown is next. And drop a comment. Where are you in your own income floor build? Month 1, month 12, or just starting the research? I read everyone. I am built and bankrolled. The sequence continues.